What's up, Outliers? Happy Wednesday. Today, we are just strolling through the markets, seeing what we see, and it would not be another weekday without a new tariff threat. Aha! The latest. You thought it was done. You thought the tariff stuff was slowing down. Ha! As if. So now Trump is saying semiconductors are going to face a 100% tariff unless the companies build in the US. This, again, reminds me of that Dave Chappelle sketch, the old gotcha bitch, because it seemed like things were generally resolved in terms of what the tariffs were going to look like. Yeah, some deadlines moving and whether or not they're going to go into effect, sliding around, blah, blah, blah. But now we're, again, playing the game of escalating again. So what's going on? Well, it's really, really simple. I was reading through the articles so that you guys don't have to. And Trump still feels some type of way about about different companies that were leaving China but did not go to the US. Instead, a lot of them went to like India and stuff like that. Here's the problem. And I mean, everybody knows this. This isn't like, I'm not saying anything fucking revolutionary here. But the fact is, the reason why these companies go to these other places is to control cost. Now, again, they have the margins, right? Like as always, like if you look at the CEO of a company and they're making $30-40 million, I can see margins right there that probably don't have to be what that probably doesn't have to be what it is. So this is not me saying this in some sort of like sympathy of the companies, but there is a reality. Like even if you started absolutely cutting the cost of the top earners of these companies, it still wouldn't make up essentially what they would lose if they had to start producing domestically and pass a lot of that cost along. So there is a balance here. Could there be a neat scenario where some of these CEOs aren't getting $35 million a year and that can be, passed down to savings to the consumer? That would be sick. But, every once in a while we have to wake up from the dreams. So the main thing is domestic production sounds great. And on some of these things, especially like more security-based stuff, I actually echo that. So things like drones. The overwhelming number of drones right now are made in China, again, because it can be done super cheap. The issue is they're becoming a really big part of warfare. And for those that don't know, there was a pretty significant Russiagate scandal a long time ago where after World War II, the US and Russia reconciled, everybody was chill. And throughout that history, we've gone back and forth of like trying to get one over on one another. And there was a period where Russia gave the US a gift. It was like a painting or something for the wall. And they fucking found essentially a rudimentary listening device in it. So, and this isn't like conspiracy, like you literally can look it up. So what I'm saying is there's absolutely benefit to domestic production with near peer competitors, no doubt. The problem is that absolutely skyrockets cost because of what we try to do in the US to provide like a living wage. And that opens a whole other bag where people will say, well, minimum wage isn't a living wage. And I'm not getting into that fight. The main thing, though, is that even the minimum wage provided in the US is unbelievably better than the majority of the globe. So that inherently will increase costs right away. Shit is just more expensive to produce here. I don't think that that's like a revolutionary or something that is going to draw the ire of people. It is what it is. So this becomes really difficult. Because from the perspective of most companies, what are you going to do? Are you going to try and actually build in the US, which we just went over the cost footprint of that, or would you play the game, pass things along, slow roll it as long as you can. And then when this dude isn't in office anymore, see if the things change. My guess is the majority are doing the latter, because that's what I would be doing. One of the downsides of the American leadership structure is it turns over every 4 years. So you don't even have to wait that long in order to wait something out in case it's not what you want. And in this case, we know it's 4 years because he already did 4. So that creates a really difficult system for these companies to say like, yeah, dog, we're going to onboard or onshore manufacturing and we're going to do it super fast. Like most of these places wouldn't be done in the time that Trump will still be president. So from a business perspective, the majority of these places are likely just going to try to wait them out. And that's why I think you see these kinds of things. So in order to try and satiate Trump, Tim Cook announced a $100 billion investment in research and manufacturing in the US. So let's learn a little bit more about this, because again, this doesn't just impact Apple. This literally impacts everything. So the move follows Apple's prior $500 billion investment in US spending, which includes working with partners to build AI server plant in Texas. It says that the $100 billion announcement includes new American manufacturing program, which the company says will incentivize global companies to build critical components in the US. So this is good element of onshoring, right? Like finding the really, really important things or the more sensitive components and finding some sort of domestic production. We went through this with chips not that long ago. So there's definitely value to be had here. Now there's a cost associated. So this so far has just been a game of figuring out how to placate what Trump wants at the cheapest total cost and likely trying to ride out, the rest of the term and see how things might play out after that, because these kinds of things are just tremendously expensive. So interestingly, with this announcement, if we take a look at NASDAQ is up right now, 0.17%. So not that that's like a big, massive up move. It's not. But the fact that it's up at all against this news is, again, quite telling. It's the market digesting this information and essentially saying, doesn't really think it's a big factor. That's exactly what this is. So this is just super, super interesting to see the thread continuing to be pulled. I thought it was absolutely hilarious to see another run on the tariff picture. But so far, I think the main stories worth covering are just earnings, because earnings has been really, really powerful so far. So if we take a look at what's been reporting, let's take a look at, I'm going to pop this over, and then I just want to flip through what's reported so far this week so that you can get a sense of what's cracking. Now, this is using all securities that have weeklies. So it's not just all going to be S&P. So we looked at some of these during the stream yesterday, so I'll flip through a couple of the bigger ones. So HIMS, they came in actually pretty good in terms of EPS, but their guidance was generally bad. Palantir absolutely smashed. I told you guys yesterday that I was adding more to the ratio call diagonal. This is hands down the largest individual stock position that I have. And I mean, this is definitely more of an investment in my portfolio versus a trade at this point. But there are a bunch of satellite positions around it that I do consider trades. But the base position right now is still what I would consider to be an investment. So they absolutely smashed. They were expected at 8 cents. They doubled it, and they're showing super good growth. We went through their earnings, so we won't spend a ton of time there. Let's take a look at RIG. So RIG, funny enough, had a decent earnings. They were expected to lose about a penny, and they came in flat. So this was a bit of a breath of fresh air for the broader energy side of the market, but notice the behavior around this volume node, and notice the behavior around this prior local highs. We saw a gap up rally, another gap up, a rally, and then it tried to rally up and out, and then it got sent right back down. Notice where it's hitting. As soon as it gets up and out, it's hitting these prior volume nodes. And again, there's no like mystique about this. This is literally just people that are getting out because they're now back at a price that they're comfortable with. So this is another really, really interesting name to follow, because I think right now it's at a very decisive point. So it's still seeing higher lows successively. And now's the first real shot we're getting if it's going to post a higher relative high. Now, this is like an easy thing to fade if you don't get the follow through, because it did see the volume today, but it wasn't accommodating volume. It had a lot of downside volume being added to it, so people selling out. Reese says, why do you think the market didn't react, just used to Trump? I don't think it's used to Trump, because that's never really the thing. It's way more the market pricing in the expected impact. So right now what the market is probably seeing is that there's still an off-ramp for a lot of companies, right? Like if you invest enough domestically in the US, Trump will leave you alone, like that kind of stuff. So yeah, I think Kirk says it reacted directly on Apple. Well, I think Reese's broader point is like, why wouldn't, 100% tariffs on semis negatively impact more stuff, which I think most things will be able to navigate their way out of it. I think that's primarily it. So Jake says, hey, I'm curious what you would do in my situation. Yeah, let me know what it is and we'll take a look. So energy, I still think is going through a bit of a transition. So if we take a look, it's starting to roll down from this prior consolidation, and it's starting to break down a little bit. So if I grab it so that it's a bit larger, you can see it's like it's flirting with falling out of this volume node. Again, you can never really take this stuff at like supreme face value, but as it starts rolling below here, that generally is not a great look for energy. Doesn't necessarily mean plummeting. I don't really get the sense of that right now, but I don't necessarily see a ton of super strong upside catalysts. So that is another broader sector that I think is good to watch for potential breakdowns, because I do think that you will find breakdowns across the board. When I look at broader market breadth right now, it's still getting worse. So the percent of companies in the S&P above 50 period moving average is now down again. Now it's down about 50%. So that's still okay, because once you have, larger companies, they can absolutely provide a little bit of a steady float, but that's still not a great trend. So this shows us that internally, a lot of things are starting to roll over a little bit. Jake says, I got UPS at 95.5 and it dropped on earnings. I was up selling options for 1 to 2% or 1.2% plus dividend price appreciation, but this drop is just dead money. What about it? Yeah, that's a pretty nasty move. It does look like it's starting to consolidate here at like the 86 handle. I remember looking at their earnings too. Like I distinctly remember that it like was looking pretty rough. Jake says, did that for about 2 months before it dropped. Now it's not able to make monthly money. Should I reallocate the money or just wait for a rebound? It's an interesting question. I think the when trading that kind of approach, you know, the people that are familiar with the community, they'll all know what my answer is, which is like, what was the plan when you entered the trade? But that's not meant to be, that's not like said in a dismissive manner. It's just to make sure that we're reminding ourselves that it's super important to think through the life cycle of a trade before entering. Now, that part aside, the issue with that kind of strategy, which is very similar to the wheel, right? Like it's a slight variant off because we're just long the equity and selling the calls in this case. But the thing that you'll run into, like this is the risk. This is the exact risk to that exact strategy. So in my opinion, like there's nothing like too crazy that happened, but the risk in the trade was realized. So in that scenario, moving forward from here, you kind of have a couple decisions to make. The main thing is like, what do you think about UPS going forward? That's the main. Jake says, plan was monthly selling options, collect dividend. And if I sell at a profit, even if small, looking for around 20% a year with my money. And that is like a really common like beginner trader mistake is notice when you said your plan, right? If we and again, this is not poking fun at you at all. There's nobody in here that hasn't done the same shit, myself included, multiple times more than I would care to admit. So this is just talking about the scenario. Some people sometimes confuse the way I talk in terms of just being direct is like being mean or something. It's really not the intent. So we've all been here. So if we talk about your plan though, right? Your plan says monthly selling of calls. And then it was to sell at a profit. The issue here is Jake says, I was in the Marines also. Then fuck you, bitch. Yeah, I didn't know that. So yeah, this is fucking stupid because if you take a look at what the plan is, the plan looks at selling calls. This is the profit side, and then selling the stock at a profit. So what does this plan completely miss? Who can give me some ideas here? What does this plan just completely miss? If we're long stock, our risk profile looks like this. Yeah, Reese is all over it, right? There's nothing in this plan that addresses the downside. Sell at a profit is a beautiful thought. I love that thought. That's good. But again, like this is the reality of holding equity is equity can go up or down. So what this is a great example of, Jake, is what I refer to as Goldilocks analysis. And it's when we're thinking about the part of the trade that we want to see, right? We want to see ourselves selling the monthly calls, collecting some income. The downside here, sell at a profit, right? Jake says, well, the plan for downside is I still get a dividend. Okay, so then you know what to do then, right? If the plan for the downside was to get the dividend, you'll still get your dividend, even though it's down here. So that's the downside plan, yeah? Obviously, what I'm showing is that that's not really a plan. The dividend doesn't mean anything as the stock starts to crater, right? That dividend starts to feel pretty insufficient. So the main thing to keep in mind always, and it's a really easy thing to keep in your back pocket going forward, is just picking points after you enter, picking points where you're like, if it goes below this, my idea is just wrong. It's just wrong. And that's okay. We will have ideas that are wrong. And one of the things you can do as a trader to really like massively accelerate your trading is just be comfortable being wrong. There's nothing, it's okay. We're all wrong all the fucking time. But what's really, really dangerous is like when we don't want to be wrong, or when we don't want to acknowledge being wrong, or we don't want to look at being wrong, because that leads to not doing anything, right? Like, so it's like as something's dropping, then we start feeling that hopium, right? Like, man, I hope this just comes back. Maybe it'll just come back and then I can get out, right? Like that's super, super normal. That's tons of people doing that. Now, this is all in the context of a trade. And I want to emphasize that point of a trade. In the context of an investment, this doesn't matter. This being at this literally doesn't matter. So depending on how you think about the position and what your original intent was, it might be a non-factor or it might be a big deal. In my opinion, regardless, I don't love UPS to the upside. So even an entry anywhere in here at like the 95 handle, I really don't love it. And here's why. Even if it's for an investment, take a look at what it's done over the last year. Take a look at what it's done over the last 3 years, right? Like when I'm looking at this as an investment, I'm just looking at something that's fucking gone down. It's had some up moves, but I'm literally just watching it consistently go down. So that's my initial just thought when I even see an entry in here, is that from an investment lens. So I don't like it for an investment from that perspective. It's literally just going the wrong direction. Now, from a trade lens, there's nothing inherently wrong with that position at all. The only thing is making sure that we have a spot clearly defined to manage the risk, where if it goes there, we know that we're wrong. Jake says, so it would have been wiser to sell credit spreads on the put side for the 2 months when I'm wrong, less capital is locked up. I don't really think you can look at it quite that way, Jake, just because the overall profitability between those is completely different. The way that I think about trading is I focus first on like what the profit mechanism is and then fit a strategy. So there's not many instances where a profit mechanism would lead me to go between, being long stock and then selling put spreads. But I do think like that is something reasonable here for the put spreads. I wouldn't get too wrapped up on the dividend, right? Jake says, well, the idea it's a good dividend and it's already beat up compared to FedEx. The problem is like things that are beat up tend to be beat up for a reason. And again, that's not to say that it can't turn around, it can't figure it out, but that requires more research than seeing like a good dividend. That's why we call them yield traps, because if you see a good dividend, it's typically, again, for a reason. Companies that are growing aggressively generally aren't paying what people would consider to be good dividends. The dividends, I think, catch so many people because, like, let's just math it out really fast. Let me grab our handy dandy workbook. And we need to find a random spot here. Perfect. So let's just take a look at UPS. And let's say our entry was 95. And let's say that we have 100 shares. It really doesn't matter. All of it will scale. I'm just starting with a general number. If we take a look at the yield, UPS yield is 7.61%. And by the way, that's going to go up as it goes down. A 7% yield is really high. So if you see a 7% yield, that typically indicates a problem of some sort, because again, it kind of has to normalize. So this yield will be paid out over the course of a year. So let's just assume that we have a 1 year holding period for this example. So if we, let's use the trailing 52-week return. So 52-week. The trailing 52 weeks is down 32.65%. So the first thing that jumps out to me is this. How good is the yield really when the principal is evaporating? So if we plot this out to get a sense of like what this can look like, this same move can take us somewhere around 64. So then our return at that point for 100 shares is down modestly. If we do this as a percentage of our total cost, we have a $9,500 investment. Did not mean to do whatever that was. Oh, that's fine. The value is at the target downside of like 64. So you're really losing a pretty significant chunk of your starting principal, right? Obviously 32% of the move. So over the lifespan of this, over the course of a year, we might say to ourselves, well, I'm going to get 7.6%. So let's see what that does for us. Which actually we kind of need to see what they've paid out because it's not going to be linear that way. So it's $1.64 that they paid out last. So that's what you get per quarter. And that's what you get for the year. This is the net loss. So the main thing to take away from this, there's nothing wrong with dividends. Dividends are okay. But the main thing is don't let a high dividend walk you into a stock that's going down, because that high dividend doesn't compensate for the directional exposure that you have. And it doesn't make pretty much any of this worthwhile. The only thing that's happening is we're tying up money, we're making a little bit on a yield, and then we're walking out net negative here. So this is a prime example of what we would refer to as a yield trap. So the dividend yield is luring you in because it looks attractive, but it's really in something that is struggling like pretty massively. And we looked through their earnings and their earnings was pretty rough. So I hope that helps at least in the context of this. Now, with respect to how you manage it, it really goes back to like what the original intent was. If this was some sort of long-term investment and you were expecting some sort of big, marvelous turnaround, then who knows? It still could be completely fine. But if it's something that you were just trying to collect a yield, then this is an example of where you realize the risk and it just happened to not work out. Jake says it wasn't just bought because of the dividend, because I felt like I had a better chance to go up. I assume, though, that you believe it has a better chance to go up simply because it's gone down, right? And that's, if that is the case, that's a bad reason. If your reason that you think it's going to go up is because of something tangible, that's another conversation. But my instinct is telling me that that's probably not the case. My instinct is telling me that you saw the high yield, you thought I want the yield. It's been beaten up already, so it's probably near a floor. This looks like a good spot to get in. That's my guess. And if that's the case, then it's really, really, really different scenario, right? Jake says, so should I hold long-term? Would rotating it for a higher monthly return be worth it? So the way to think about that is, let's pretend, Jake, that you don't have a position on in right now. Let's say you have nothing on in UPS. Do you want to buy 100 shares of UPS right now? So mentally get rid of the position that you have and then evaluate it as if that position isn't there. Jake says, yeah, that's a good guess. Plus, I watch you and this other group he mentioned is a potential good long-term. Yeah, I mean, I don't see it that way. The way that I trade is completely different. Again, like, I'm not in the business of just trying to make things okay. What I'm in the business of is finding the best place to put my money, right? And again, a recent great example of that is Palantir. This thing has been smashing. It hasn't been smashing for 6 months. It hasn't been smashing even for a year. It's been smashing for 3 fucking years. Like, this is one of the things that my money is in. So the point is I wouldn't try to make UPS work because there's a position in there. If it's genuinely a position that you like, great. That's totally, totally cool. Nothing wrong with that. But you have to be absolutely certain that the reason why you might like UPS has absolutely nothing to do with the position you have on in it right now. And it would be only because of the research you've done and some sort of strong conviction that UPS would look different over the next year than it has for the past 3 years, which has been this. And that could be. But the only way to ride out stuff like this is if you have decent conviction in it. So another really solid test to take in that kind of thing is, like, if UPS goes from 80 to 60, what would the response be? What would you think? My guess is you would think, fuck, I wish I got out. That's my guess. And if that's the case, that tells us that it's really not a fundamental play. If that change in price would lead to that response, it means that we're still price sensitive. If instead, if I said, what's the response if UPS goes to 60? And the response is, well, it depends on what the fundamentals look like. And if the fundamentals haven't changed, I would buy more. That's somebody that has conviction and that believes in the thing that they're holding, which is a completely different scenario. So I think your response to that might also help weigh in on, which way you might choose to take that trade. To me, the question is always, always, always not, could I put a trade on here? The question is always, is this the right place for my money? And if somebody told me you have to put on a trade in UPS, personally, I would go short because of what it's doing. It's my hunch would be on a continuation of the trend. Benian says, can someone tell me what Greek caused my call to go down in value if the underlying changed 0 on the day? I don't think it's theta. It should not be that much for one day. Yeah, so it'll be 2 things. It'll be theta, and then it'll also be vol, simply. There's also the reality that depending on what it is, it could be part of the bid-ask spread where it's marked at and stuff like that, but those will be the primary drivers for sure. Benian says, IV did not change though, bizarre, and theta should be about 2%, so that's why I'm confused. No, it's not gamma because gamma is the rate of change of delta. So there's no impact on gamma. But IV, there's really one of three things happen there. Theta decayed more than you thought. IV changed and you didn't see it somehow. Or it's literally just the bid-ask spread, depending on where the market's offered at right now. Because obviously having no idea what the ticker is. But if the bid-ask spread moved on the day for whatever reason, that can change what the unrealized P&L is of the stock for sure. Little Oopsie says, when you think of selling calls in a medium gamma environment, where do politics play into it? ¿Qué dices? I don't know what you mean by a gamma environment, but I mean, more broadly, politics, at least with how they are now, that's more just like a catalyst because that provides a continual series of vol to trade depending on like what you like to trade. But I don't know what you mean by medium gamma environment. If you're talking like spot gamma, just in terms of dealer exposure, like GEX, that's kind of a different thing. So I'm not positive. I definitely want to be able to follow the question though. So if you can help me understand, I'm happy to try to answer or at least take a closer look at it. But current state, I don't totally follow. While we're doing that, let's take a quick look at a couple broader market trends. Jake says, one last thing. If you made a fundamental flaw like me, what would you do with your position? I mean, personally, if I didn't like it for a long-term investment, I would get out. Like the thing itself right now, from like an entry of 95, let's say that it's currently priced at 86 and a quarter. I mean, it's down only 9%. That's not like some sort of massive down move, right? Like, so regardless of the total capital that's in it, it's less than a 10% move. It's uncomfortable, but yeah, like if I didn't like this from a fundamental perspective or have a very specific reason to get in, realistically speaking, I would have been out here. Like, if not here, definitely here. And the reason is, even if I were trying to play this near-term bounce, and this here doesn't look too unhealthy, right? So if I can't plot here because I have an alert, but this doesn't look terrible. But the way that I follow stuff like this for a more active position is by ratcheting up where I would get out. So the original exit point would be somewhere below this recent low. Like if it goes lower than this low, this is going the wrong way. So yeah, if it's my position, if I don't have some sort of specific reason why I want to be into UPS, which I certainly do not, I'm out. I'm out and I'm moving on to something else. There's so many other things that are doing really, really well that I would spend essentially zero time even fucking with this thing. I still imagine it does look like it's trying to rally out of this drop. So the fact that it's not like this precipitous continuation is good for creating some level of stability. But that doesn't matter to me. Like the way I look at this kind of thing is like, even if it did rally back up to where I was before, like that's not a win. That's just, it's now back to where it was before. And again, like over that time frame, there's shit that's moving so much easier. That's the thing is like, I don't like playing the game on hard mode. I really don't. So what I mean by that is I very rarely would pick a specific stock and be like, I got to do something in this stock. Like if there's not something that like really appeals to me in that stock for some reason or another, I'm going to go look at one of the 5,000 other stocks. and find something that's an easier play for me. That's how I would be approaching it. It's just a very, very different approach than like a fundamental investor, though, which again, it's important to note that for sure. Kirk says, would the delta drift down on a weekly sold call if the stock didn't move for a day? Yeah, that's called charm. So that is a higher order Greek that we can measure. It's also referred to as delta decay. So for a quick, fun recap here. So if you go to charm, which is this one here, aka delta decay, it essentially tells us how much delta will decay based on 1 day change in time. And the way to visualize charm is this. It's this steepness. If nothing else changes, these options get steeper and steeper this way and steeper this way. Now, on I'm assuming a pretty small position, 1 day change, that wouldn't be a contributing factor in this specific scenario, but that is an effect, and it's actually a good one to be generally aware of. Yeah, for sure, Jake. Happy to help, man. The markets are really tricky because it gets people doing a lot of stuff that they think might make sense. And then there's so many like small gimmies and gotchas. And there's a lot of gotchas because the market, I see it all the time. As you guys know, I spend time, poking around on Reddit, just trying to see what people are thinking and ideally seeing if there's something of value that I can try to help get people to think of things slightly differently. And it's really, really common. Like another common one that I notice people have a general issue with is understanding the fact that like selling calls this is a great example. The process of like selling calls on a dividend stock is almost always going to underperform buy and hold dollar cost average, almost always. The benefit to it is it'll have lower volatility, which is good, but it'll underperform. Same thing for the people that like to trade the wheel. If you trade the wheel, that historically will underperform buy and hold in the same thing, regardless of what it is. Now, it's in general. There are absolute instances where it's not the case, but as a broad strategy, it typically is. A couple other things. I do want to talk about some recent earnings plays from the last few days. So earnings plays from yesterday, there was 4 that I went with. First one was Lucid. Lucid was super, super interesting because Lucid was priced to move. One sec, I got to refresh this so that my numbers work. Lucid was priced to move around 11%. The average realized was 9.1. The average implied was 14.5. So this one had really good vol edge. This was a really, really simple trade. That one, I'll tell you if it was a straddle or strangle. What did I do? That one was a straddle. And that one didn't really return that well. So the stock went down 11.84%, actually slightly outside the expected move. But I still ended up 4.2% return on invested capital from the short straddle, literally because of how much vol came out when it did. It's like such a great example of how volatility can really save your ass on these kinds of things and dampen things significantly. Because I had the 2.5 straddle. So I was... When did it report? Because I obviously had a bit of a skew to it. Yeah, so it was after the market yesterday. So I was playing the skew on it because I definitely didn't run the 2. The 2 is too far away. But they were higher deltas at the time, which I'm a little confounded by because the 2.5 is like way up here on the day. But anyways, Still will be much closer than like the 2 for the straddle. The calls at that time were a 49 delta. The puts were a 51. The couple that worked really well was open. This is the second one. Open was originally expected at 24%. And the overall move literally ended up being 24.6 on the day. But again, the vol that came out of there was just insane. So that one was also a straddle. Funny enough, that one was also at the $2.50 handle. So that one was a really solid return comparatively. That was like a 24% return on invested capital. And then the last two, Rivian, RIVN, they were priced at 9.3. They were realized at 4.2. So that was a really profitable one. This one was not a straddle. This one was a strangle. It was the 13.5 and the 11s. So that one was like a 31% return on invested capital. And then the last one was U. It was 4 for 4 yesterday. U was a straddle at the 34.5. And this was originally priced at a 13.3% move. It ended up like, what, 6? So also pretty light move. So for the list of things that we originally looked at for the Tuesday PM, we looked at one, I won't list the names. It'll be faster just to count. We looked at 21 names. Of those 21 names, I'll tell you how many made the short list. Of those 21 names, 10 made the short list. Of those 10, 4 were actually placed. That's like a pretty average earnings day. Not like maybe a little bit slow. Maybe, normally between like 6-ish, but close. So Dark Mark says, did you end up putting anything on Celsius for tomorrow? Not necessarily for tomorrow, but I have stuff on in Celsius just based on the flow that we saw. So I'm not looking to play it directly for earnings. I actually don't care that much on earnings. But this is what ended up sticking out to me the most. So the put premium today went absolutely parabolic. So as this started going haywire, I literally just shorted it on the day and then I closed out. So I was pretty much only trading it intraday. I didn't bother past that. I don't have a big opinion on it for earnings, at least as of now, but this was a massive series of puts that rolled through. But I think I was looking at them before. I think a good number of them were sold. Yeah, like these, the 33s look like they were sold. But then the 41s look like they were bought. So, yeah, really, really interesting behavior. I just had a really brief intraday trade. I don't have anything on in there for earnings. For earnings tomorrow, I have six names on. And I think we reviewed most of them yesterday, at least the ones that were generally interesting. Sky says, what's your view on using OI as a proxy for liquidity? I mean, there's nothing wrong with it. But to me, that's like one factor of many. So I use OI definitely to help me identify better strikes and stuff like that. It becomes really relevant. A great example is in box spreads. So when I'm trying to trade box spreads, it can be really, really difficult to find liquidity because in order to put on fewer of them, I have to go super wide. But as I'm trying to go super wide, like this is a great example, right? The 4750, you can see that there's 15,000 OI. Like I definitely will use this as a base to try to find like where I might want to run, the box spread. The main note here is you kind of know where the liquidity is going to be. If it's there, it's going to be at the round numbers. So like, again, the 4750 or the 5,000 in this context, that'll hold through for just about anything that you trade. The round numbers almost always are going to hold most of the liquidity. The better measure for liquidity, I would say, is the bid-ask spread. And something that like new traders or smaller traders, there's actually a big luxury in the bid-ask spread, because a small trader that's coming in here to put on like a 5 lot, they could see that this is 12 cents wide and they could easily fill a 5 lot. The problem is like, if you're trying to trade any of this stuff at any marginal scale. So again, let's use an actual example here. Let's say let's pick something for earnings tomorrow. Let's try Joby. Good old Joby. So Joby, if I want to trade this for earnings tomorrow, let's say that I'm going to run the 18. Now, again, I'm in the pass-through IRA account for this. So I'm going to use my phone real quick to figure out like what the actual margin requirement would be for a 1 lot so that I can give you guys an example. All right. So this is with portfolio margin per 1 lot. This is asking for 115. 115 bucks. So this is the 18. We're going to get 210. And then it's asking for, let's just call it 125. So then let's define where the risk is, like how the way that I expect to plan the risk for this trade specifically. I would have used like, this is based off of spot price. How close is spot price? Yeah, that's good enough. 1640, 21.5. So here's what that would look like. We would see like, what's the loss at 1640 and 21.5? Call it down $2,000 for a 1 lot. For your loss plan. So now let's just scale this. Let's say that you have we'll just use a blank million for context. The reason why I'm not using $100,000 because $100,000 really wouldn't run into, well, we could start with $100,000, but you'll see it's not really going to run into a lot of liquidity issues. So let's say that we're going to size our earnings plays as 1%. So this times this gives you $1,000. So, I mean, realistically, yeah, it's for a naked in this, you wouldn't even be able to run this. So let's do $1 million or 10 million if you want to be super rich. $10,000. So this, you need a 5 lot. That's actually completely legit, to be honest with you. That's completely fine. So let's use another example. Hertz. The black tar heroin. So we don't really need these. So for Hertz, let's say we ran the 5.5. We get 82 cents. the loss management plan on this would be, oh, I forgot my trade. Would be like 4.5 and 660. So 4.5, this is a good example. 4.5, you lose $31. 660, you lose $48. So let's call it $50. So now all of a sudden you see what you need, right? So you need 200 contracts. You need a 200 lot. So then if I go in here and I look at the size for these, like what's the offer, right? I'm looking to sell. So what's the bid? Their bid, this midpoint, so their bid 40, there's only 61. On the call side, if I look at the actual size, it's 134 by 1. So what I'm showing you is like, as you start to scale, you literally run out of liquidity and you're going to move the market on yourself, which is always super annoying. So that's one of the downsides as your account grows, is like you actually have to plan for this as you're trying to put on your positions, especially if you're trying to do anything submitted as a complex order, which is really, it's like anything beyond 2 legs, you're essentially fucked. You'll have to leg into most of it in some capacity. It's just how it is. I'm going to grab the door for Thor real quick. Your boy will be RB. All right. The homie has returned immediately into his bed. Kirk says, how can you tell if they are bought or sold if they have a buyer and seller for each transaction? Just filled closer to bid or ask? That's exactly right. So the way that platforms like that will make the determination on whether or not something is bought or sold, it's not even if it's closer to the bid or the ask, but if it's at the bid or the ask. Again, going back to people that are trading at size, when you trade at size, the mid doesn't exist. That's not a thing we get to use. So in this case, for this example, like you're not playing this at 40 and you're not playing this at the midpoint. Again, it literally doesn't exist. So when we're looking to play these kinds of things, you're essentially transacting at the bid or at the offer. That's what happens when, again, you're sizing things up. So the benefit of that is most of the informed parties on places like this, as they're putting on positions, it's generally going to be at the bid or the ask. So we can kind of cleanly see. Now, again, it's still not perfect. There are rare, but instances that do occur where somebody can transact at the bid, but it's actually a bot, which is, again, super uncommon, but it does happen. So another important thing just to keep in mind. Rational says dividend stocks are kind of silly. They're basically saying we have no more great ideas to invest in, so we'll just slowly give you your money back. Not really, to be honest. I wouldn't view them that way. High dividends are scary, but dividends, like the way that shareholders are paid is in one of several ways, right? So let's take a look at something like Apple. I would argue it's kind of crazy to say something like Apple doesn't have any good ideas. I would highly disagree with that. But something like Apple has so much cash that there are different mandates on what they have to do in order to reward shareholders. So if we look at the price performance over a long enough time frame, so let's do from 23 to current, This is 65%. That's a completely solid return. But for larger, more stable companies, you're naturally going to run out of market cap. There's only so much money in the world. So dividends just become one of the mechanisms that you can essentially reward shareholders. That buybacks becomes another. So I wouldn't bucket dividends in that way. Now, again, if it's a high dividend, that's alarming. That's bad. That causes a whole lot of concern. But dividends in general, it's just one of the many ways that companies will pay shareholders for holding, provide a return of some sort. Sky Shadex says dividends used to be a lot more important before stock buybacks was a thing. Yeah, and that's exactly right? So that's another form of just really balance sheet manipulation in order to pay shareholders. The good part about a dividend is that that's a realized gain. A stock buyback is not a realized gain. And again, there's pros and cons to both of those. The con is there's generally a taxable event. The pro is you can literally buy more units of the company with the realized money. You can't do that with a buyback. It's just what you have is now more valuable. So there's actually quite a bit of depth that goes into deciding the way that you want to reward shareholders, because there are different considerations to make for sure. Rational says, ever come across safe wheel strategy? Sell a put, buy 3 150 puts. I hate this so much. Buy 1 teeny call to help the head. I hate these. I hate those kind of trades so much. Let's model it. Let's see what this thing looks like. So we're going to sell a put. Rational says, could you share? I'm trying to learn. Oh yeah, no, sorry. I'm not like picking on your strategy at all or what you're coming across. It's just those kinds of things are typically when traders, they really want to have the cake and they want to eat it too. And it never works out the way that people typically expect. I'll just look it up really quick so I can get the actual parameters. What is the safe wheel strategy? Let's see what Gemini says. Okay, well, while that's thinking, I'm just going to build what it might be. So we'll sell a put. And then we go 150 days out. We'll use this one to be in the main. And then we go out of the money as a hedge. I don't know how far. Maybe we'll do like 11 delta. And then you said we buy a call? That's super far out of the money. So we'll do like a 2 delta. Yeah. I mean, I just hate these kinds of strategies. It's for a few reasons. The first thing is these kinds of strategies, they put traders in a really, really bad spot. The way you make money as a trader is by taking risk. If we are so concerned about SPY or whatever it is going down, that we have to trade this kind of thing in order to feel comfortable putting the trade on, it literally doesn't make sense. if we look at the most probable ranges for this stock over the next 30 days, which is the primary holding duration for the 19 SEP or 40 days or whatever, let's just take a look at what that is. So we're out in 19 SEP, which is here. So the one standard deviation range right now places us at 597 and 675. 597, which is here, and then 675, which is here. In both of these cases, this loses money. Now, I'm sure you can tinker with where the puts are and stuff like that to make it a little bit cheaper so that maybe it's a small gain. But the more important point there is, even if it is a small gain, it's a small gain in the most probable band that this thing is going to move. So this is why I take issue when traders get... I really think the majority of retail traders shouldn't even say the fucking word hedge. I think the vast majority of retail traders just need to size things appropriately and take the fucking risk. There is always a time and place for hedging, for sure. But for the majority of people, the only thing you're doing is sabotaging what you might make. So in this case, if we had just sold the put and it essentially stays within that general expected range that we were just looking at anyways, you make $728. So when we look at this comparatively, you lose $500 or whatever, right? Like it just logically doesn't really flow. Rational says, I'm trying to figure out what I'm missing. Sounds like I'm not missing much. No, I mean, I can tell straight from the word, right? Safe, whatever. Anything that's safe is not going to be super profitable. It'll definitely reduce downside variance, sure. But again, like the way we make money as traders is by taking risks, not hiding from it at all passes. So yeah, like these kinds of, I've seen millions of different versions of these things over the time. And like, I've never come across one where I'm like, yeah, that's solid. There was one that was going around for a while, which was like the 112 or the 212, like these different fucking ratios. And it's the same thing. It's literally the same exact nonsense where we're grossly overcomplicating what we're trying to do instead of just getting good at base profit mechanisms. If you spend that time and effort and energy just getting good at basic profit mechanisms, you don't have to try to come up with an option strategy that essentially doesn't lose a lot and makes a bunch in all scenarios. You just get better at the scenarios you employ the toolkit in. Way more profitable than the rest of that nonsense. So yeah, interesting question though. All right, gang, it is time for me to bounce. Gonna go grab some dinner, go for a walk. As always, if you need anything, you know where to find me in the Discord, be an outlier. See you guys later.